Hey everyone, Iggy here, and welcome back to Module 4 of the 100K Dividend Foundation. In the last 3 modules, we learned how to analyze dividend stocks for safety, decode the key metrics for S-REITs, and build our stability pillar with SSBs, T-bills, and bonds. If you missed any, the links are below. But here's where most investors freeze. How much of each? What percentage splits make sense? How do you actually combine these into a portfolio, especially if you're starting with $100,000? The confusion is real. You see conflicting advice everywhere. And meanwhile, your money might be sitting idle, losing purchasing power to inflation. This module changes everything. We're tying it all together into one coherent strategy, the 100K framework. This isn't some rigid formula, it's a balanced starting point designed specifically for Singapore investors who want growth, income, and stability without losing sleep. The 100K framework operates on a simple truth. Balance beats brilliance. Real wealth isn't built on risky bets. It's built through consistent, diversified growth across different types of assets. Think of your portfolio like a 3-legged stool. One leg is growth through stocks. Another leg is income via REITs. The third leg is stability using bonds. Remove any leg, and the stool gets wobbly when markets shake. Keep all 3, and you create something resilient. Singapore's market is perfect for this. We have solid blue chip stocks, Asia's largest REIT market outside Japan, and safe government bonds. You can't predict when the market will go up or down, but you can control how you allocate your money across these strong pillars. Spreading your capital reduces risk and captures growth from multiple sources. So here's the foundation of the framework: 40% core stocks, 30% high-yield REITs, and 30% stability bonds. These percentages aren't random. They come from research and fit Singapore's market well. Let's break down why. First, 40% in core stocks acts as your growth engine. We're talking established blue-chip companies like DBS, OCBC, or ST Engineering. These provide growth through rising share prices and stable dividends. 40% gives you meaningful exposure to market growth without being overly concentrated if the market corrects. Why not more? Because many Singapore investors value income too, and our CPF already provides a retirement base. This framework complements that. Next, 30% in high-yield S-REITs is your income generator. Singapore REITs often yield significantly more than government bonds, sometimes 5%, 6%, or even higher based on market conditions. This 30% allocation targets diversification across different property sectors, maybe some industrial, some retail, some commercial. This balances the desire for high yield with risk management, as putting too much into REITs makes you vulnerable to interest rate changes. Finally, 30% in stability bonds is your risk anchor, your defense. When stocks and REITs fall sharply, high-quality bonds often hold their value or even rise as investors seek safety. This 30% allocation protects against major losses and helps you stay invested during market panic. Bonds also provide steady income through coupon payments and offer capital preservation that other assets can't guarantee. Let's make this concrete. Imagine you have $100,000 ready to invest. Here's how the 40-30-30 framework translates. You put $40,000 into core stocks. To avoid putting all your eggs in one basket, split this across 4 to 6 different blue chip stocks. For example, you might put 10K in DBS, 10K in OCBC, 8K in SIA, 7K in ST Engineering, and 5K in Capital and Investment. This mix gives you exposure to banking, aviation, defense, and property. These stocks typically pay dividends, generating around $1,600 to $2,000 per year on this 40K, plus potential capital growth. Then you'd put $30,000 into high-yield S-REITs. Again, diversify across 3 or 4 REITs in different sectors. For example, 10K in Capitaland, Ascenda's REIT. Industrial, 8K in Fraser Centrepoint Trust. Retail, 70K in Capitaland Integrated Commercial Trust. Office/retail, and 5K in Mapletree Industrial Trust. Data centers. With typical yields of 5 to 7%, this 30K allocation could generate roughly $1,800 to $2,900 per year in distributions, usually paid quarterly. Lastly, you'd put $30,000 into stability bonds. The simplest way for beginners is often using bond ETFs for instant diversification. For example, You might split this 30K between a Singapore government bond ETF and an investment-grade corporate bond ETF. Depending on the bonds, yields might range from 2.5% to 4%, generating approximately $900 to $200 per year in interest income, providing that crucial stability. So let's summarize the income potential. Your 40K in stocks might generate $1,600 to $2,000. Your 30K in REITs, $2,800 $2,000, and your 30K in bonds, $900 to $200. Add it all up, and your $100,000 portfolio is generating roughly $4,300 to $5,300 per year in passive income. That's about $350 to $440 per month, before considering any potential capital growth. And over time, as dividends and distributions rise, that income can grow organically. Now, the 40-30-30 split is a balanced starting point. You can adjust it based on your personal risk tolerance. Conservative investors nearing retirement might dial back stocks to 30% and increase bonds to 40%. Younger, more aggressive investors might push stocks to 50% and reduce bonds to 20%. Those prioritizing income now might increase REITs to 40%. The key is that even these variations maintain diversification across all three pillars. Can you use your CPF or SRS accounts for this? Absolutely. CPF ordinary account funds above the first 20K and SRS funds can often be invested in eligible stocks, REITs, and bonds, ETFs. Using these accounts can offer tax advantages. However, there are specific rules and trade-offs, especially comparing potential returns against the guaranteed CPF interest rate. I'll cover CPF and SRS investing strategies in more detail in future content, but know that this 40-30-30 framework can be implemented within those accounts. A quick word on keeping your portfolio balanced. Over time, because stocks tend to grow faster than bonds, your 40-30-30 split will drift. Maybe stocks become 45% and bonds shrink to 25%. Rebalancing, usually once a year, means selling a bit of the winners and buying more of the laggards to get back to your target. This forces you to sell high and buy low, and it's a crucial discipline for long-term success. Finally, let's touch on common mistakes related to this framework. First, don't chase high yields blindly. A REIT yielding 12% sounds great, but it often signals high risk. Focus on sustainable yields from quality assets. Second, don't neglect diversification within each pillar. Putting all 40K of your stock allocation into just one bank is too risky. Spread it out. Third, don't abandon your strategy during market volatility. The 40-30-30 structure is designed to cushion falls. Stick to the plan. And fourth, don't try to time the market. Waiting for the perfect entry point usually means missing out on gains. Invest according to your allocation and stay invested. So there you have it, the 100K framework. But 40% core stocks for growth, 30% high-yield REITs for income, and 30% stability bonds for safety. It's balanced, it's tailored for Singapore, and it gives you a clear blueprint to start building your portfolio with confidence. You now have the what and the why. What's left? The action. In our final module, Module 5, I'll give you the exact 3-step action plan to turn this knowledge into reality and actually start building your portfolio. Click the link on screen or in the description below to start Module 5, your 3-step action plan. Let's finish strong. See you there.